Welcome to Bloomberg ETF IQ. I'm Katie Greifeld. Scarlet Fu is off today, so let's get at the biggest stories right now in the nearly $15 trillion global ETF industry. And we start with U.S. stock markets under pressure. The sell-off lessening a little bit relative to this morning, but investor fears remain for President Trump's next tariff rollout expected on Wednesday. And amid all the market volatility this year, emerging markets actually have outperformed the S&P 500. Life and Liberty's Perth Tolle joins us in just a moment to discuss. And BlackRock projects that outcome ETFs will triple to $650 billion in assets by 2030, just as AQR comes out swinging against buffer strategies. We'll dig into that debate, all of that and more coming up. But first, Eric Balchunas from Bloomberg Intelligence, he's here with us now. He's looking at the flows. Eric, what do you got?
Thank you, Katie. I figured, it's the end of the quarter today. Well, let's look at the quarterly flows. We normally look at the weekly flows. There was some S&P 500 rebalancing that made the weekly numbers a little wonky. But anyway, it's a good time to reflect on the year. So far, $34 billion into VU. What can you say? That puts it on pace to blow away last year's record of $100 billion, which blew away the year before $50 billion. So VU just in a league of its own. IVV, $21 billion. I think some of this is tax related. So we're looking, it's still seeing inflows, but not quite as big. Now, SGov, this is treasuries, right? So people are, they're buying beta. They're still buying stocks, but they are buying treasuries too, and look, a little gold. So there's a little protection going on for sure. But VTI is the total market, and this is another S&P. So you've got basically 4 U.S. stock ETFs in the top 5. No Europe or international. More on that in a minute. Let's go in the outflows. SPY is the top here. So that you say, well, that's a little bearish, perhaps, but that's a lot of tax loss harvesting money that came out in January. SPY also sees migrants go over to the IVV and VU ETFs for lower fees. This is a growth fund. This is probably BlackRock's models. Money out of energy, a little money out of government. Interesting, some treasuries. That's the full curve there. Some people may be picking their battles on the curve. But let's look at the full quarter. And I want to break it down by geographic focus here, which really is fascinating because my colleague Andre Yap made this. This is looking at U.S. equity ETFs, $138 billion for the year, right? And here's international. So despite all you've heard about outperformance and U.S., lagging, everybody's still investing in it. $138 billion blows away the quarterly record for flows. That's how much money has gone in. So it's not just people keeping up. They're actually going above and beyond. It could be people rebalancing into the U.S. and buying the dip. And look at international. It's actually down. So really, nobody is really biting on the headlines that are saying international is the place to be, at least for now, Katie. A couple more months of this, we'll see.
Yeah, we'll see. Though I will note that the European Stock 600 index had a record quarter of outperformance relative to the S&P 500, but U.S. investors, they just don't care. Eric, thank you. Let's keep the conversation going now with Perth Tolle. She is founder of Life and Liberty Indexes. And Perth, we're all counting down to Liberation Day. That is what President Trump is calling this Wednesday when we finally get more details on his tariff plans. I want to couch this conversation in FRDM. This is, of course, is your Freedom 100 emerging market ETF. And the way you weight countries is really interesting. You use basically economic freedom metrics to decide your allocations. And I'm wondering how you factor in tariffs to those portfolio decisions.
Yeah, thanks, Katie. So basically, we do use both personal and economic freedom metrics in determining our country scores in the emerging markets. This is especially important because emerging markets are full of autocracies, countries just coming out of autocracies, and some have very bad personal and economic freedom kind of policies. So with economic freedoms, there's things like taxation, rule of law, business regulations, and freedom to trade internationally as well as sound money. But in freedom to trade internationally, there's 9 variables that we look at, including things like tariffs, non-tariff trade barriers, and freedom of people and goods to move across borders. So all of those things factor together as part of the 86 variables into our country weighting methodology.
So I want to talk about how your portfolio could potentially be affected. I take a look at your top holdings here. I see Samsung, for example, then I see some chip makers, TSMC being among the largest of your holdings. I mean, do you try to tariff-proof the portfolio, or how do you stay true to your methodology while also trying to maybe protect the portfolio?
Yeah, so because it's a passive index portfolio, we don't try to tariff-proof it or make any changes due to everyday news on the tariffs, but we try to be in the countries that have the best, freest trade policies, best rule of law, so countries that have stronger institutions and stronger protections for trade, whether it's IP protections or investor protections or just freedom of movement. And so, the companies that have been affected in our portfolio are TSMC, Samsung, Foxconn, Hyundai. Hyundai just pledged $21 billion investment in the U.S., including a steel plant in Louisiana. Foxconn has pledged moved over 16 billion in operations out of China into other countries since 2018, along with other Apple suppliers. And TSMC pledged an additional $100 billion investment in Arizona. So there's a lot of trade that's moving out of our portfolio companies into other countries, a lot of it coming to the U.S. Hyundai's CEO just came out and said the best way for us to position ourselves in this environment is to basically localize in the U.S. But the best way, I think, for investors to protect themselves in this environment is to invest for the rebound. After everything is said and done, all the tariffs have quieted down. The countries that have the best trade policies are going to be the ones that benefit from this.
So let's talk about that a little bit, because I'll see online, they'll be like, tariffs are awful, this is killing us, please stop. Then the counter is, hey, look, there's tariffs, like the US didn't invent the tariff, okay? There's tariffs all over the place all the time. Can you talk a little bit about which countries have tariffs currently? Do you think the response is justified at all, or will this just harm the US and EM will benefit?
Yeah, so I don't think that it'll necessarily benefit EM. It does harm usually the country that is imposing the tariffs. So we believe tariffs are so integral to economic freedom. It's such a foundational part of the freedom of choice, and any kind of restraint on that, we prefer not to have. So it's a restraint on economic freedom. And so the countries that have done well in this area, that have the best trade policies in our portfolio, are Chile and Poland. Two of the best performing countries year to date. Actually, they've performed better than China year to date. China and India, a couple of the poorer trade policy countries. India historically has had very protectionist policies, and they do have a very small part in our portfolio as a result of that. But they've done well because they have a strong internal consumption market, whereas China's internal consumption market is weakening.
So let me ask you this. When you're on the road talking about this fund to advisors, it's a really strong case. No China, no Russia, democratic countries in the EM. But what about just trying to sell EM? As I just showed, it is really tough to get the U.S. investor to dislodge their home bias. They seem to be just really into just plowing money into the U.S. regardless of what happens. Are you finding any cracks in that?
So we are here for investors who want EM, but maybe want it in a less scary way. So in a way that we're in the countries, emerging markets are scary because there's a lot of autocracies there, and there's a lot of things going on that maybe clients don't want to be a part of, like Russia back when it was in the index, and China these days. But there's a way to invest in that we're providing that gets around that by basically being in the freer countries, the countries that have better personal and economic freedom protections. Personal freedoms like terrorism, trafficking, torture, freedom of media expression, civil freedom, political freedoms, and then the economic freedoms like the freedom to trade internationally, sound monetary policy, and stable currencies. So all of these things added together make the Freedom 100 strategy kind of a safer way to invest in emerging markets that maybe will be less scary to investors.
Well, let's talk about year-to-date performance a little bit, because FRDM, you're up about 7.6% on a total return basis, obviously handily outperforming the S&P 500. But then you take a look at FXI, which is the iShares China large cap ETF, up about 17.5%. To be fair, it hasn't seen that type of performance in a while. But Eric just asked the good question. I mean, how is it selling EM? Is it more challenging to sell ex-China right now? Because, again, outperformance, you mentioned Poland, you mentioned Chile, but what's top of investors' minds, it feels like, is Europe and is China.
Yeah, so ex-China this year, I think, is actually either negative or flat. So we are very different from the ex-China strategy, where it's arbitrarily excluding China out of the market cap-weighted indices. We're not arbitrarily excluding any country, we're just freedom weighting. So the higher the freedom in a country, the higher its weight. And by doing that, we have higher weights to Chile and Poland, both countries that are very overweight in our strategy, but very underweight in cap-weighted strategies. And due to that, we have outperformed EEM, IEMG, VWO, and all the basically broad market funds that have a lot of China in there.
So FRDM, I remember when you were just an index. You came on like 6 years ago.
That's right.
You're almost $1 billion. Congratulations.
Thank you.
Usually when an indie gets $1 billion, they start thinking sequel. And so do you have any sequels planned?
We do. We have some things that may round out the suite for us that our clients have been asking for, especially in this this global trade war environment. They're saying, hey, maybe it's time to apply this strategy to other asset classes. So yes, we are looking at sequels.
All right, so watch this space. It sounds like hopefully we'll be talking again very soon.
Yes.
Our big thanks to Perth Tolle of Life and Liberty Indexes. Now coming up, the world's largest asset manager is betting big on a growing breed of derivatives-powered ETFs, even as critics like AQR speak out. We'll discuss the debate next. This is ETF IQ on Bloomberg. All right, welcome back to Bloomberg ETF IQ. I'm Katie Greifeld. It's time now for the ETF brief, where I walk you through the trends and the stories that caught my eye in the ETF industry. And we start with active ETFs, finally surpassing that $1 trillion milestone. We know that active ETFs have been in demand among investors and among issuers as well. They've launched a record amount of funds for the first quarter. Active, a big part of that, again, crossing that $1 trillion milestone. Let's talk about Texas, though, and specifically about BlackRock and their plans in Texas. They filed for the iShares Texas Equity ETF last week, actually Friday, like 4:45 p.m., which was fun for me. It'll be passively managed, and it will invest in companies headquartered in Texas. And let's keep sticking with BlackRock. It sees outcome ETFs jumping to $650 billion by 2030. This was interesting because just within the same few days, AQR of Cliff Asness fame came out swinging against the rise of options-powered funds that limit losses during downturns. Specifically, Principal Daniel Villalon says that, quote, it's an investment failure. The vast majority of these funds have neither kept up with equities nor have they protected investors from the downside risk. Obviously, that caused quite a few waves. Let's keep talking about buffered ETFs with Bloomberg's Denitsa Tsekova. So there's a distinction to draw there. Of course, BlackRock was talking about outcome ETFs overall, including buffers, and AQR was specifically taking shots at buffered ETFs. Walk us through sort of the basis of their argument against these very popular strategies.
Yeah, so AQR is focused specifically on those strategies who use bearish options and like they promise protection like 10-15%. That's the usual thing we get. AQR has a simple thesis. If you put most of your money in the S&P 500 via passive ETF and then you put some money in cash, you're going to have smaller drawdowns and bigger returns. So they're saying that this is a marketing success. Obviously, a lot of those products are marketed as something where you can chase the upside, be protected from the downside. So it's kind of a very interesting proposition in that sense. We actually know that some big pension funds have been interested in those buffer ETFs and staying away from hedge funds. So clearly, we're talking about a rapidly growing industry that's taking money from other corners. It's kind of a simple proposition. AQR is obviously famous for trend following, risk premia, all those super complex systematic approaches, which you can imagine it's kind of harder to sell to investor, but obviously they're a massive company.
Yeah, these products, I actually didn't think they'd be a big hit. They were too complicated, I thought. But I realized over time what I think the paper misses, it's accurate, these are smart people, but the psychology. So I've had a note about how ETFs are a little like the pharma industry. Yeah. These products relax you. I mean, they lock in, no downside.
It's like popping a Xanax.
It is. It really is. It's like curing a feeling of anxiety. And I think that's underrated. If you're an advisor and you deal with these people, they know. And I think that's maybe an underrated part of this is the psychological effect of these products.
I totally agree with you. And we also have a lot of the big names backing those. You have JP Morgan, BlackRock. So that's definitely adding to that aspect, right? It's a big recognizable name. Some of the products are above 30, 40 billion. So we're talking more about the covered call products here, which is part of the BlackRock analysis, but those products are big. Institutional investors are interested in them. So there is definitely that aspect of it. But all of those products have largely underperformed the market by a massive gap during 2023, 2024. They really rose in popularity in 2022 when we saw bear market in bonds and stocks. So they were really good too. And actually year to date, they're doing very well. So the growth has continued. The inflows are there.
And you mentioned that underperformance, and I'm going to steal an idea from Eric Balchunas and Bloomberg Intelligence. I mean, you guys have posited that you shouldn't necessarily compare these to stocks. They work as buffer bond replacements. Rather, we had Bruce Bond on the show who was also furthering that argument. I don't think that came up in the AQR paper, that idea.
AQR, they do both. They do purely stocks and stocks plus cash. And when you combine with cash, actually, stocks and cash is better at protecting a drawdown. So that's one thing they mentioned.
Yeah, it's the Buffett portfolio. He says go 90% S&P, 10% cash. That's what is in his will. But I do think that most people own the ag, and that did go down in 2022, to your point. So these are potentially a bond replacement.
For sure. But we see BlackRock is very, very bullish in the industry. We're seeing tripling assets for the next 5 years, which, you know, a lot of people are saying it's absolutely possible. They're growing so fast. It's interesting. We have two types of products. We have all those big asset managers just launching of a newer version of the S&P plus a covered call or, buffer ETF. But then we also have like all those super volatile stocks, the MicroStrategies, the Teslas, having a version of a covered call or a buffer strategy. So you have like the two extremes of the industry. You have those big institutional asset managers and you have a smaller independent issuers like doing products that are more like a retail trader catnip.
All right, Denitsa, great reporting, really diving deep into that debate. That is Bloomberg's Denitsa Tsekova. Still ahead, we'll speak to Ethan Powell of Brookmont Capital Management on the upcoming launch of the world's first Catastrophe-Bond ETF. And also a reminder, you can listen to Eric and Joel Weber on Trillions. It's their podcast that covers the industry. This is ETF IQ on Bloomberg. This is Bloomberg ETF IQ. I'm Katie Greifeld. It's time for today's drill down where we focus on one ETF. Eric, what do you got?
Today, Katie, we have a brand new ETF. It actually doesn't launch till tomorrow, so a sneak peek of the Brookmont Catastrophe-Bond ETF. This is the first cat bond ETF in the U.S. ILS is the ticker. It just came out. Interesting category, alternative insurance. So what are these bonds? Basically, you kind of play the role of the insurer. The insurer transfers risks to the investor. If there's a fire or hurricane, it hurts the investment. If there isn't any, you get more yield. That's basically the gamble here. And you see it's coming out tomorrow on April 1st. It's actively managed. And let's look at the holdings. Here's some of the bonds in it. We're going to talk about that in a minute. So here you go. So if you know what these are, we're going to discuss this in 2 seconds, but that's what it holds. And let's look at the performance here. We're a little pressed on time, but I want to just show you. Here's a Catastrophe-Bond ETF in Europe. You can see it's beating HYG, but look at all the yield it produces. That's 9% yield. So more yield, a little more juice, and that could get some looks, Katie.
Eric, thank you. And joining us to talk about this ETF, I'm thrilled to say we have Ethan Powell. He is principal and CIO over at Brookmont Capital Management. Great to have you in person. So this is the first of its kind in the U.S. And with any first ever ETF, the natural question is, why? Why now and why this product?
Well, it's interesting. The asset class itself has matured dramatically alongside the ETF fund wrapper, right? I mean, if you think 15 years ago, the ETF fund wrapper was low-cost beta. Last year, there were more actively managed ETFs being launched than there were passive, right? And if you look at the catastrophic bond asset class 15, 20 years ago, it was sub 10 billion. Today, our investable universe sits at 50 billion. And you were talking about the AQR report on buffered ETFs, and turns out they're not as non-correlated as you thought. Here you were talking about the intrinsic nature of these bonds being tied to weather volatility, which results in a 0.2 correlation to basically any risk asset class.
All right, if we could bring up the holdings again, because obviously didn't know anything about them. I was very ignorant. Can you just go through a couple, like what are you buying here? What are these linked to? What kind of disasters?
Yeah, so if you think about a normal corporate bond issuance where they raise money and then they use the proceeds for general operating costs, these are special purpose vehicles, right? And so the Jamaica, right? That's a name that you may remember. So that's actually the country of Jamaica issuing a catastrophic bond to help them recover and create a resilient society in the event of not just a hurricane, but a series of hurricanes that exceeds what's called the attachment point, which is where you as a bondholder are indemnifying the issuer.
And we only have about a minute left with you, which is probably not enough time for this question.
We'll be around, Katie.
I'm going to try anyway.
Okay.
Eric and I just got back from the exchange conference in Las Vegas, and there was a lot of chatter about this ETF, and there's some concerns about how would a market maker actually, hedge a catastrophe bond? How do you do that? And I'm curious how you went about finding a lead market maker, for example.
Yeah, that's an interesting question, right? Because if you think about corporate fixed income, there are correlations between sectors, between coupon, duration, et cetera. So even if one bond isn't trading, you can infer some trading prices from other more actively traded bonds. Here, there isn't a correlation, right? Yeah. I mean, California wildfires basically have nothing to do with Florida hurricanes, right? Which leads to some issues in hedging. And for us, it's a floating rate yield. So if you think of bank loans as a good comp, obviously bank loans have credit risk. These do not have credit risk. They're floating rate, no credit risk, fully cash collateralized. Yeah, I mean, it'll be interesting to see how we navigate the liquidity aspect of it. But, the bond issuance is over $50 billion, which compares favorably to a lot of muni bond ETFs out there. And the bid-ask spread is sub 60 basis points, which compares favorably to the CLO market, which there's billions of assets in. So I think we'll figure it out.
All right, Ethan, great to speak with you. Of course, that ETF launches tomorrow, April 1st. That is Ethan Powell of Brookmont Capital. And you can read all about this drill down, plus the latest in the ETF industry when you subscribe to my weekly ETF IQ newsletter. The link is right there, bloomberg.com/ETF IQ newsletter. But that does it for Bloomberg ETF IQ, the TV show. I'm Katie Greifeld alongside Eric Balchunas, and this is Bloomberg.